over the macro show. As a reminder, the Consumables show is every Monday at 12 o'clock, and we'd love to have you join us for that and have lunch on Mondays with us. So I'll just brief through quickly some slides here, and I want to go through some trends in the restaurant space and then give a preview of the Instacart deck that we're going to do on Thursday. But you can see our position monitor on slide 5, still slightly bearish for the most part, but a few of the more conservative asset-light models that we like alongside, and the restaurant industry price performance ranked as of Monday. You can see on slide 6 and see your favorite stock there. So every week I get on the call and talk about Hedgeye Restaurant AI, if you will, and that is the cell phone trends that are across. We have this detail across almost every brand, but you can see on slide 7 the monthly casual dining weekly traffic trend, and it's shown a deceleration pretty much since January for the most part, and into the most recent week, where we saw a significant deceleration, and September was starting out in the hole. Same thing on slide 8 for the QSR names, and there's been more of a deceleration in the QSR names, and that's really been driven by McDonald's. McDonald's has fallen off the cliff. For some reason, we were going to dig into that, but I want to point this out because while it's not perfect, it does give you directionally the trends, accelerating, decelerating, which as you know, we care about a lot here at Hedgeye. And when you look at the actual data that's reported, which is on slide 9, where this is the Knapp-Tracker data, and this is for the casual dining industry. Indeed, the weekly data that we talked about on the call did show a significant deceleration in August, going from 4.4% comp to 1.9%, and you saw traffic go from 1.9% to down 3.1%. Now, or 3.1%, excuse me. So this actually is better than I would have thought, and it doesn't mirror the traffic data perfectly because the traffic data was showing the worst month for the year. This wasn't the worst month of the year, which means there's a slight acceleration in the 2-year trends, which is a net positive, if you will. But for the most part, directionally, you're seeing a significant slowdown with sort of one positive big growth in the 2-year stack improved in August. But you can also see on the left side of that chart, comparisons are going to get more difficult, except for November, December, and then into January, February. So we'll see how things unfold here when the payments begin to occur in October. And then you can see, and then again, the next slide is the weekly trends, and this is the Knapp-Tracker weekly trends, and you can see again, a deceleration on the right side there throughout the quarter. So the cell phone data is mirroring exactly what's happening with sales. Now the difference is it's really hard. It's a little more difficult to narrow it down at the stock level just because of what every company is doing for price, whether they're raising price, what's happening in average check, and mix and whatnot. So it's a little trickier to get down to the stock level, but certainly directionally you can begin to understand which way you're going. Importantly, there are 3 big states that comprise most of the industry sales trends. You can see that on slide 11. California actually is the best performing state, up 3.6%, but again, traffic is negative. I'm sorry, Texas is the best performing state on slide 11. And Texas, believe it or not, trends in Texas have a lot to do with oil prices. So if oil prices are going up, you tend to see comps do a little bit better. California has shown a pretty significant slowdown on slide 12, and notably a big deceleration in traffic in the month of August. And then Florida has been the worst performing state pretty much all year. I'm not really sure what's going down with Florida on slide 13, but nonetheless, none of the trends across any one of these states look positive. Well, to broaden the industry data out to include the quick service trends, the same idea here. You've seen a big slowdown in both sales and traffic with the 2-year trend restaurant sales have been slowing all quarter. Yet if we look at the next slide, slide 2, when we look at across the 9 different segments of the industry that we follow, you're seeing revenue revisions actually go up, and earnings revisions go up, except for the entertainment sector and Dave & Buster's, who are probably the biggest in the entertainment sector. But this doesn't jive with me. So, and this gets to the point when we get to the earnings season, I would suspect, and we saw this in the second quarter too, we'll see in the third quarter, you have companies missing on revenue expectations because the sell side is slowing down their estimates because they're just not incorporated at the company level. We're seeing it at the industry level, sales slowing, but it's not incorporated into the estimates on a company level. So I would suspect there was only 1 or 2 companies in the second quarter that beat analyst estimates. Nearly everybody missed on the revenue side, but with pricing coming in, that trend, especially headed into the fourth quarter, you're going to start to see, instead of a miss and a beat on sales and earnings, you're going to start to see a miss and a miss. And I suspect, again, this quarter we're going to see top line. So I just want to spend a few minutes here on Instacart, having a great time, frankly, digging into this company. It is it's fascinating to see Instacart and DoorDash, and we'll have a lot more detail on Tuesday at 2 o'clock when we talk about Instacart. But when we look at the brick meat splits online grocery trends on slide 17, a big slowdown in the numbers through July with August data yet. There's Instacart order trends have slowed significantly, and they were actually down 1.9% in Q1, and then up 3% in Q2. And this is the rub between these two companies when people are going to compare DoorDash and Instacart. DoorDash, if you look internationally, is seeing double-digit order growth. Now, the issue I have with DoorDash, frankly, is that they don't talk about their core business. Their core business is restaurants. The last couple of years, they've moved into grocery, and they don't talk about, at least publicly, they whisper in the ear of certain shareholders of what their restaurant orders are doing, and they're low single digits, so no different than what we're seeing, frankly, the order trends for Instacart. But you're seeing much better trends at DoorDash, which, arguably, how are you going to value this company? You can value on order trends, you can value on profitability. The difference, though, for Instacart is advertising. DoorDash does not have an advertising business model, and when you go back and you look at what we're talking about DoorDash and how we're pitching DoorDash, it's the intersection of content and commerce, meaning that they have a ton of content on their platform, and this is why Pepsi is participating in the deal, because Pepsi understands how important it is to be able to advertise on DoorDash. There's a couple examples that we'll have in the back on Red Bull, and how significant the Red Bull, how significant it was when they were advertising their single serve Red Bull cans, and how significant that was. So when you look at slide 20, which is the advertising revenues, this is the reason why Instacart is so profitable. Now, the interesting slide of slide 21 is the market share analysis, and you can see as DoorDash has entered the market, right? They have grown their market share, but they haven't taken market share from Instacart. So they've been able to take market share from Amazon, from GoPuff, from Shipt, and they haven't really been able to dig into the Instacart market share. So this is going to become a battle, right? This is going to become that battle of market share. Really become the two players. It's now going to be DoorDash and Instacart for the most part. And this is, this will obviously be an important metric to follow going forward. But if DoorDash can't take market share from Instacart, how important or how significant is that going to be for the future order growth, right, for DoorDash? Because they're growing today and they've been able to accelerate their order growth, but if they're not going to be able to take incremental market share in this segment, because this is a no-growth segment. Jamie will talk about the industry in a second, but essentially, the restaurant industry and the food away from home or food at home grow potentially at upper. So it's a low single digit, maybe 1% growth. So it's going to become a market share battle. And this is the important slide for me is the difference in profitability. Right? You can see on slide 22. Cart is profitable, DoorDash is not. And DoorDash won't be profitable anytime soon. And as you saw DoorDash enter into the grocery space, right? Because they saw growth slowing significantly in the restaurant business. The losses accelerated. So they're going to really need to focus on profitability going forward, I think. And I don't have a lot of confidence with that because it's going to be expensive for them to start taking market share from Instacart, and especially if got whether you've got the consumers, you've got the stores, and you've got this advertising business model, which allows the CPG companies to focus on spending more on the Instacart platform. It could bode well to the market for Instacart. So there is a ton more detail we're going to have on Thursday about the business model. We're going to break down the advertising model, we're going to break down customers, cohorts, and the stores, and then I'm going to turn it over to Daniel because he's going to talk about
Thanks, Howard. So my first slide is Staples Position Monitor. We can get into some questions later in the Q&A part. I'm going to start, like Howard said, the grocery industry, what's happening there. I know not everyone has spent a lot of time on the grocery already. Just to give you an idea of what's happening in the grocery industry. So on the next slide, we've been living through a period of unprecedented inflation, and now we're in a period of disinflation. This is, going hand in hand with strains in consumer budgets. It's probably, worsening, right? So we've been calling for deflation in the perimeter of the grocery store in the second half of the year. We've already seen those signs now, but we no longer expect the center of the store to follow the perimeter of the store. So the perimeter store is like a bakery. Things are touched and processed less, so bakery, meat, seafood, things like that. So there's less touching by the companies and more reflecting on the raw material costs. On the next slide, you can see that's so no surprise, sales are decelerating for the grocers. And following the slide, you can see the food retail market share. Grocery is a local game. It's a ground game. Right? It's no different for delivery as well. So you can use Instacart or Walmart Plus to get your groceries from Walmart. Walmart is the largest grocer in the country. On an annual basis, the price is the same. Instacart does offer quicker delivery, but the differences aren't that significant between them in terms of cost on a daily basis. In many cases, what you're choosing is not really a choice, right? It depends on where you live. For example, if you're in the city, Walmart Plus really isn't an option. If you're living out in more rural areas, Instacart's really not an option. So, it does matter where you live, and that's why there's no one national rule for every grocery delivery. But Instacart does have these. If you scroll down to the number 3 grocer, right? Instacart does give you access to Costco, even without a membership. So there's some nuances to the ground game here for Instacart. That's the share. And what's happening in digital grocery on the next slide, we have digital grocery household penetration. No surprise that it continues to fall here, from the peak of the pandemic. This is slide 38. And the penetration is only up some 50%, from pre-pandemic times, but the business itself is quadrupled. So even though you're obviously going to get some people who are trying out digital grocery for health reasons rather than just grocery and convenience. So no surprise we're seeing a little bit of that give back. But what trend would we have been seeing if there wasn't so much inflation and pressure on the consumer budget? That I guess we'll find out when it stops inflating. And then finally, as a reminder, grocery delivery for the grocers is not a profitable endeavor. Right? So this is from question, but Instacart offers a solution for it. Sales. So, and with that, I think Howard, I'm going to turn it back to you for.
For that last point, Dan, so that's how important the business model is, the advertising component of it, of DoorDash, right? I mean, sort of Instacart. You don't make money delivering food, but if you can have an intersection of content and commerce, you can have an advertising model and help CPG companies drive sales, you know, it's a different element to their game.
Right, and Howard, I'll turn it over to you for some cannabis slides.
We're gonna, we just, yeah, sorry, I wasn't prepared to do that, but, so I just wanted to show the performance of the cannabis industry, you know, how strong the performance is, although it's a restaurant industry on there, it should say cannabis industry, but it's really been amazing over the past month how, you know, how strong this performance is for a number of these names because of what's happening with with the potential rescheduling from Schedule 1 to Schedule 3, which could be years away, right? So we're not buying into this rally. Certainly it is a relief rally, but we've got a long way to go. And then the next two slides, if you look at monthly sales trends are getting a little bit better. So this is purely a rally on the potential of a rescheduling, which means, you know, the taxes could, the 280 taxes could go away, but, you know, fundamentally there hasn't been a big change. We're still seeing significant price compression across a number of states, and, you know, so meaning the sales growth in the industry is basically flat or up single digits. So, and then with that, I'll turn it back to you for questions. Sorry about that. I forgot we were doing that.
No worries, and we have questions, but you can still have some time to put some questions in there. I'm going to start off with the most thumbs up question, which is on cannabis, Howard. We've had this huge run in MSOS, but it's clearly overbought. Is this rally sustainable?
There's nothing more powerful than you making your thing happen. Really going for it.
What is a bank deposit? A bank deposit is the debt of your bank. They must take it back in payment of any debts you have to the bank. So you repay your loans with bank debt. So the same is true for all money. What is unique about the state's money is the state can put you into debt. Okay? You owe them taxes. Then they say, oh, here's my IOU. You can use this to pay your debt. Okay? So only the sovereign can put you involuntarily into debt. In all the other cases, you are more or less voluntarily getting into debt. You say, hold it, I really needed that bank loan. Right? But there is at least some voluntariness in you choosing to become indebted to the bank. You don't have a choice whether to be indebted to the government. You owe taxes. So the state's money is the state's debt. Coins are the debt of the Treasury. Paper money is the debt of the Fed. And the government has agreed to accept it back in payment to the government side. Skip over some of these things. When we go around the world today, and we go back through time, Keynes said 4,000 years at least, but probably now we push that back to 6,000 years ago. The typical case is, as Charles Goodhart, who worked at the Bank of England and at the Treasury at one point, put it, one nation, one currency rule. It's a good argument. And it's almost always true. When you go back in time, you'll find that each nation had its own currency. When you go around the world, you find it's typically true. countries, the state doesn't directly spend currency, as I was saying. The central bank stands there to make and receive payments for the treasury. So it really will be reserves that are created, which are the liability of the Fed, rather than green paper notes, which is the liability of the Fed. The central bank stands ready to supply and drain reserves in order to keep its interest rate on target. And this idea was adopted in the endogenous money approach. From the late 1970s, post-Keynesians were arguing that central banks can't control the money supply. And what they mean by that is the money that is created by banks. They argue that when banks have good customers come in that look creditworthy, that want to take out loans, what the banks do is they credit their demand deposits, which is the bank liability. And that the idea that the central bank can constrain that by constraining reserves is just wrong. It doesn't understand the way that central banks actually have to operate. If they want to hit an overnight rate target, they have to supply the reserves that the banking system needs. If they want the payment system to function smoothly, they have to supply the reserves that banks need for clearing. So actually banks can't constrain, central banks can't constrain the quantity of reserves. They need to supply it on demand. In the 80s, when Post-Keynesians was writing this, this was very much against the mainstream, in which the mainstream argues central bankers can and do control the quantity of money. There's something called the deposit multiplier, so the banks can multiply the quantity of reserves, but the central bank can always control it. Over time, this view that central banks actually can't control the money supply has come to be accepted by virtually everyone who studies central banking and by central bankers themselves. So, for example, last year, the Bank of England put out a piece that says central banks cannot control the quantity. What we do is we set interest rates. So out of the various heterodox approaches that modern money theory was built on, this piece became widely accepted within the past 20 years. The other pieces, not so widely accepted. The next early precursor is Ava Lerner, who developed what he called the functional finance approach. And he counterposed this to the sound finance approach. The sound finance approach basically sees the government budget as being similar to a household budget. And this is, widely accepted. You hear politicians all the time saying, if I ran my household the way that Uncle Sam runs his budget, I would go broke, which is true. Okay? Households cannot continually deficit spend. Okay? They will go bankrupt. Ava Lerner said, but this doesn't apply to a sovereign government that issues its own currency. It cannot go bankrupt. And in fact, it should not run its budget the way a household runs its budget, because its interest is the public interest. Okay? And balancing the budget, the government budget, has no obvious public purpose to it. Okay? The government can and should run its budget differently. Okay? And this is what he means by it should be a functional finance approach. Try to pursue the public interest. Well, what's the public interest? Ava Lerner said that the two most important things the government can do is to pursue full employment and relative price stability. Okay? And what that means is that you use the budget in order to achieve full employment. If there's unemployment, either taxes are too high or spending is too low. So you need to adjust those. You need to increase spending and reduce taxes in order to move the economy. Of course, if spending is too high and taxes are too low, you go beyond full employment, you get inflation. So the solution to that is to reduce spending and raise taxes. So this is functional finance. That is his fiscal policy recommendation. His monetary policy recommendation is that if the public has too much money, then the government ought to supply more bonds. If the public doesn't have enough money, the government ought to supply fewer bonds. You can see that this is very similar to what I was arguing before. The purpose of bond sales is to drain excess reserves out of the banking system. Okay, the purpose of bond purchases is to put reserves into the banking system. So this is exactly what Lerner was recommending for monetary policy. In other words, you want to hit an interest rate target and you make sure that the banking system has the right amount of reserves. Beardsley Rummel, which is a great name, was the president, the name of the office in the 1940s was chairman of the Federal Reserve Bank of New York. We changed it, they're now presidents. The chairman of the Federal Reserve Bank of New York, and he's also the father of income tax withholding. Wrote two interesting papers at the end of World War II in 1946. One of them was titled Taxes for Revenue Are Obsolete. The purpose of taxes is not to raise revenue for the government. Okay? He says in the paper, World War II has taught us the government doesn't need tax revenue to spend. How did it teach us that? Because during World War II, the budget deficit was 25% of GDP. Okay, that's 5 times bigger than it is now as a percentage of GDP. The government was 50% of GDP. The government debt ratio was 100% of GDP. Okay? So we learned in World War II, you don't need tax revenue to spend. Okay? Taxes serve other purposes. You can use taxes to fight inflation. You can use taxes to punish bad behavior. You can use taxes to change behavior. You can use taxes to reduce the income of the rich. But taxes are not for revenue. Okay? This is the chairman of the Federal Reserve Bank of New York. Hyman Minsky, who was my dissertation advisor, was famous for financial instability hypothesis. So this is also incorporated within modern money theory. The most famous line from Minsky is stability is destabilizing. So if the economy appears to be operating in a very stable manner, the problem is that people will change their behavior. They will assume that it's safe to take more risk. As they take more risk, the stability disappears and you get a financial crisis. Okay, so in one sense, that's the theory. And so by using the understanding of sovereign currency, which came from Nat, Innes, Goodhart, and so on, we were able to, beginning in 1992, to write about the coming crisis in Europe. That the way that the euro was set up, by trying to divorce fiscal policy from the sovereign currency, as each country adopted a foreign currency called the euro, we said that this system will not be able to deal with its first serious financial crisis. And then following Minsky, we said, aha, we have our chairman, Greenspan, and Bernanke famous for eliminating risk. Okay? When Greenspan was the chair of the Fed, we said, oh, there's the Greenspan put. In other words, go ahead and take all the risk you want because you know that no matter what happens, Greenspan won't allow anybody to fail. Bernanke even wrote a paper called The Great Moderation, central bankers know what they're doing now, you can trust us, therefore there is no risk anymore. Financial crises are a thing of the past, we're not gonna have them anymore, okay? So we said, you know, this is exactly what Minsky's talking about. The stability will create the instability. So we said, we're going to have a major financial crisis, compounded by the Clinton budget surpluses that put the private sector so heavily in debt, by the deregulation pushed by Greenspan, Larry Summers, Bob Rubin. We're going to have a massive financial crisis, which the U.S. will be able to deal with because we're a sovereign currency. Euroland will not be able to deal with it. They will face a crisis they cannot get out of. And so in addition to the creation of the blogosphere, being right about these two things also increased the credibility of the modern money theory. The last piece in the history of thought that led to the development of modern money theory is the idea of employer of last resort. So Abelardo says if there is any unemployment at all, it can be eliminated by the government spending more. Now, the problem is that you can get inflation. Lerner thought you get inflation only when you go beyond full employment. Now, in the 60s, he changed his mind on this. But writing in the 40s, his prescription was just spend more. Okay. The problem is we get inflation long before we get full employment. And so the government has to cut back its spending, raise taxes, slow down the economy before we ever get to full employment. So Hyman Minsky, who's known for financial instability, in the 1960s worked to develop a proposal of employer of last resort. So he argued that only the government can afford to hire all the unemployed. And so it must be the government's responsibility in order to maintain full employment. And we do that with what we now call a job guarantee, employer of last resort. So what you want to do is design a New Deal's style jobs program in which the government takes workers as they are, pays them a wage which will become the minimum wage throughout the economy. Hopefully it's a living wage. And then finds useful things for people to do, just as the New Deal jobs program did. I know that you're all young and maybe you don't know too much about this. 13 million people were employed in the New Deal jobs program. The biggest was the WPA, which employed 8 million people. You can still see the output of these workers all over the country. They build thousands of schools. They build probably tens of thousands of bridges, hundreds of thousands of miles of road. They built public buildings all over the United States. They brought a country that was a developing nation into the 20th century. It's not an exaggeration to say that they developed America. They made America a developed nation. The New Deal jobs program. So the buildings all over the United States. They brought they build thousands of schools. They build probably tens of thousands of bridges, hundreds of thousands of miles of road. They built public buildings all over the United States. They brought a country that was a developing nation into the 20th century. It's not an exaggeration to say that they developed America. They made America a developed nation in the New Deal jobs program. So this is what Minsky had in mind when he talked about it. I won't go any more into the tiny details of how you run the program to make sure that it is not inflationary. But Minsky argued this practical will not cause inflation, whereas just having the government spend more could be inflationary. Okay, so anyway, those are the foundations. To just quickly conclude, the policy implications are, first, we need to stop saying we can't afford things. We can always afford it. Okay? There probably are a lot of spending proposals that are bad ideas. Okay? So we can always afford to spend, but we need to spend on things that make sense. We need to spend in a way that is not inflationary. We need to leave enough of the resources for the private pursuit of private interests. You know, Americans like a small government, so I'm not necessarily arguing for a bigger government than we have now. We need to preserve a large private space, but it doesn't make sense to leave resources unemployed. If the private sector doesn't want to employ them, we ought to be employing them. And there are things in the private sector cannot, such as public infrastructure, which is, much of that is not profitable. So this needs to be undertaken by the government. The second implication is, you know, we need to stop talking about central bank as if it were completely independent of government. It's not, and it should not be. It's a branch of government. It has some independence, but every department of government has some independence. We want them to be independent of, you know, the day-to-day political games that can be played, and it's very good that we insulate our policymakers from that. But they are not independent. They were created by Congress. They're a creature of Congress, and Congress can change the laws if they don't like what the Fed is doing. We need to understand that balance is balance. It would seem like this is an obvious thing to state that at the aggregate level, the surpluses have to equal the deficits. But in 1999, there's the front page of the Wall Street Journal. I can show you if I have the PowerPoint. On the left-hand column, there's a graph which shows the government sector running a surplus, and the headline is, "Isn't this great? For the first time since 1929, the U.S. government is adding to national saving by running a budget surplus." They show the picture. Then on the right-hand side, they show the private sector, okay? And of course, it's running a deficit. And the headline is, "Isn't it terrible? The private sector now is running a deficit, reducing national saving." Okay. There's no mention in either of the articles to the other article that it's an identity. You can't have the government sector running a surplus without the private sector running a deficit. Okay. So if we understood this, a lot of nonsense would disappear from public debates. If you like private sector saving and accumulation of wealth, then you love budget deficits. Okay? Because it's the other side of the coin. It's the mirror image of the private sector saving. And so we would, you know, if people understood this, we could change the nature of the debate about deficits and debt, and whether government debt is a bad thing, whether it burdens the future generations, and all that, because it's all based on not understanding that the balances have to balance, that the deficits accumulate to private sector accumulation of wealth, which most people think it is a good thing. Yeah, I don't know what time is it. I'll watch.
Whenever.
Well, it might be good to take questions.
So let's thank Brandon Ray for having us. Anyone who needs to leave for a class or has anything can leave, and we'll go for 10 minutes.
Can behave much differently from a sovereign currency user. You guys are all users. Okay? Uncle Sam is the issue. It makes a big difference, whether you're a user or an issuer. The sovereign government chooses the money of account. In the United States, we call it the dollar. In Canada, confusingly, they call it the dollar. In Australia, they call it the dollar. In the UK, they call it the pound. It's the unit of account. The sovereign then issues a currency denominated in the same unit of account. So in the United States, confusingly, we call little green pieces of paper dollars. And we use the same term. But one is the currency, the other is the unit of account. They impose taxes in the same currency. Okay, so you owe dollar taxes. They accept their own currency in payment of taxes. In the old days, you actually would deliver the currency to pay your taxes. Nowadays, mostly you do it electronically or maybe write a check. Prices generally are denominated in the same money account. Maybe not all prices, but most prices, most of the time. Contracts are written in the same money account and enforced in courts in that money account, usually, not always. When you have a sovereign currency, there is a spectrum of exchange rate regimes that you can choose among. And what we argue is that a floating exchange rate provides the most domestic policy space. You can manage your exchange rate, which is what China does. And that might reduce your domestic policy space. You can peg your exchange rate, which many countries do, they peg to the dollar. That further reduces policy space. You can adopt a foreign currency as your own currency. Some countries have dollarized. So Ecuador adopted the US dollar. That severely constrains domestic policy space. You can adopt a gold standard. You can adopt the euro. Those reduce your domestic policy space. So if you want to maximize your domestic policy space, you adopt your own currency and you float. Okay? That will provide the maximum domestic policy space. The problem with fixing your exchange rate is that you need the foreign currency that you affixed to. Or if you're Ecuador, you actually need to get US dollars. That constrains your domestic policy space because you have to operate your economy in a way that ensures a flow of dollars into your economy. Usually this means what you want is a trade surplus. If you want a trade surplus, you usually have to adopt some form of austerity. You have to keep wages low. You have to keep domestic aggregate demand low so that your population won't buy imports because you're trying to run a positive trade balance. That's why it reduces your domestic policy space. Now, a country like China today has an unassailable foreign currency reserve, $3 trillion of foreign currency. Even George Soros will not attack that. And part of the reason why they've accumulated that amount is because George Soros attacks countries that peg and don't have enough foreign currency reserve. George Soros brought down the United Kingdom. One guy brought them down. They had to abandon their land. Okay? So that is the danger, and that is why your domestic policy space is reduced. You can't pursue things like full employment policy, because full employment could lead to your wages rising and could lead to your population importing, which reduces your trade surplus. Someday, China will float their currency. Someday, China's trade balance will turn around, probably a lot sooner than what most people believe. Why? Because they are allowing their wages to rise. They actually have a policy of wage increases. And so they're not going to very long be a low-cost producer. So they will float their currency in order to protect their domestic policy space. That's a prediction. And economists are often wrong, but I think that is what we're see. All right. Finally, final topic on sovereign currency. If you issue your own currency, you can't run out. Uncle Sam can't run out of his own currency. He never needs to borrow his own currency. And in fact, if you think about it, borrowing your own currency would make no sense. It would be like you've written an IOU to your neighbor. I owe you a cup of sugar. And you find out you need another cup of sugar. So you're going to go try to borrow that IOU back from your neighbor in order to get another cup of sugar. No, you're going to write another IOU. Okay? So I'll come back to this, but sovereign countries don't need to borrow their own currency. In fact, there's no balance sheet operation that you can show me in which someone borrows back their own IOU. And this was Warren Mosler's brilliant observation. Bond sales are not a borrowing operation. They're something else entirely. We'll come back to explain what that is. Now, sometimes countries borrow in foreign currency, okay? And you can borrow foreign currencies. Again, the problem with borrowing foreign currencies is that you have to pay back in foreign currency. And so that will constrain your domestic policy space. So I would say almost always it's a bad idea for governments to issue debt in a foreign currency. If that is similar to adopting a fixed exchange rate. You're going to have to operate your economy in such a way that you can get the foreign currency to service the debt. So it will constrain your policy space. Okay, the second point. Taxes drive the currency. This is a shorthand way of saying that sovereign government that chooses a money account and issues a currency in that money account needs to create a demand for the currency. The way they do that is by imposing an involuntary obligation on the population, the citizens or subjects, depending on whether it's a democracy. They impose the tax or some other involuntary obligation in order to create a demand for the currency. Okay? Historically, the main obligations were fees and fines. But from the 19th century forward, taxes have become the most important obligation that you have to pay in your nation's own currency. From inception, if a government announces, we're going to have a new currency, we're going to call it the dollar. And here, I want to buy something from you with dollars. You would ask, well, why do I want the dollars? Okay. And I said, because you have to pay taxes at the end of the year. Okay. The obligation is necessary from inception in order to drive the currency, to create a demand for the currency. Now, what we say is that taxes are a sufficient condition. They might not be a necessary condition. Sufficient condition means that if you have to pay the tax in dollars, you will demand some dollars to pay the tax. So it will create a demand for the currency, at least up to the amount of the tax obligation. Taxes might not be necessary to drive the currency. Okay, we can be agnostic on that. You might be able to come up with another explanation for why people would demand a currency, even if there was no obligation that they had to pay in that currency. I haven't heard any. The typical answer I get is the do-a-dope. Well, I accept currency because I think Buffy Bob will accept it. That's do-a-dope. I think I can pass it along to someone dumber than me. I'll accept the currency. That's the typical explanation for why people accept U.S. dollars. We can do dopes with it. Okay? That's not satisfying. I think the reason we accept dollars is because a lot of Americans have to pay taxes in dollars. But we can say that taxes at least are sufficient, and they might even be necessary in order to drive for the currency. From inception, you can't pay your dollar tax unless the government has provided some dollars. What this means is the government needs to spend the dollars so that you can pay taxes. In other words, the logic tells us that the spending comes before the government can collect the taxes. Because you can't pay your taxes until you've got the dollars. If the dollars come from government spending, the government needs to spend before you pay your taxes. So logically, the government doesn't spend taxes. Logically, the government spends so you can pay taxes. The spending has to come first. What that means is taxes actually don't finance government spending. Now, of course, if the government has been spending for years and years and years, a lot of dollars can accumulate in the hands of the non-government sector. Okay, and so that you have accumulated dollars that you can pay taxes with. However, they all came from the government spending originally. So once we've developed a monetary economy that makes lots of dollars in circulation, then this logic becomes less apparent. You say, hold on a second, I have a lot of dollars to pay my tax. I don't need to wait for the government to spend. But the government had to spend from inception in order to get the dollars into the economy so that taxes could be paid. The sovereign government the sovereign government that issues its own currency cannot be revenue constrained because it issues the dollars as it spends. If it wants to spend more, it issues more currency. It can't be revenue constrained. It can't run out of its own currency. It does face constraints. The main constraint it faces is the resource constraint. It can run out of resources to buy. It can push up the prices of resources. So, too much government spending can cause inflation. As people long argue. But it can't cause insolvency. It can't cause insolvency. It can't cause the government to run out. So the fourth point is, there is no solvency risk for a government that issues its own currency. There is no possibility of bankruptcy. When President Obama tells us that the U.S. government has run out of currency, he is misinformed. It can't happen. The U.S. government can always issue more. It's not possible to run out. There's no chance that running budget deficits, spending more than tax revenue, is going to bankrupt the United States government. Can't happen because we can always issue. We can always make all payments as they come due. The second kind of constraint is that the government can put constraints on itself. The United States has a very bizarre constraint, the debt limit. Okay? No other country that I know of has one of those. So Congress imposes a debt limit on the U.S. government. And we've had this since 1913. Whenever we came up close to the debt limit in the past, Congress almost always, really without debate, raised the debt limit. So it never was an issue. It was a constraint, it was never constraining. Okay? A few years ago, the Republicans decided to make it an issue to try to enforce policy changes that they want by saying we won't approve and increase the debt limit. So it became a big political football, and we're going to hit it again very soon. And so what I'm saying is you can impose a debt limit constraint, you can refuse to raise it, and you can force the government to default on its promise to pay interest on the outstanding government bonds and other promises. It can be forced to break its promise to Social Security recipients. Say, sorry, we hit the debt limit. We can no longer write the checks for your Social Security. But that's a self-imposed constraint. We can remove the constraint anytime. Congress can either raise the debt limit or just get rid of the stupid debt limit altogether. Say, that was a bad idea. And it was a bad idea. And most other countries haven't imposed this kind of constraint. So what I'm saying is, you can impose constraints. Okay, but the market doesn't do it. Okay, there actually is no reason why the U.S. government can't continue to spend and meet its commitments, pay interest to the bondholders, and pay Social Security payments to the retirees. simply by issuing currency. Fifth, sovereign government doesn't need to borrow. It can't borrow its own IOUs. Some people think that the reason that the government is borrowing is because it needs to finance its deficits. But actually, the bond sales come after the government has deficit spending. The deficit spending creates what we call high-powered money, which is currency plus reserves, that is used to buy the government bonds. So this was the inside of Warren Mosley. Everyone knows that the reason the Fed sells bonds is to drain reserves out of the banking system. Okay, well, this is not controversial. Everyone accepts this. Okay, it's in every money and banking textbook. An open market sale is to drain reserves from the banking system. So Warren is sitting there and he's, but hold it, what happens when the Treasury sells bonds? It drains reserves from the banking system. Exactly the same. They are identical operations, just by different branches of government. And once he realized that, he said, then bond sales are not borrowing operations. It has nothing to do with borrowing. It has to do with draining reserves. Why do you need to drain the reserves? Because deficit spending means the government has credited more bank accounts than it debited. The government spends, it credits bank accounts nowadays. When taxes are paid, the government debits bank accounts. That means that the government is spending more than taxing, it is net crediting bank accounts. It's increasing the recipient's bank account, and that bank's reserves at the Fed get credited. Excess reserves in the banking system drive the overnight interest rate towards zero. Excess reserves drive interest rates down. The reason the Fed sells bonds is to drain the reserves out so it can keep the overnight rate, Fed funds rate, on target. So the purpose of bond sales is to allow the central bank to hit its interest rate target. And it doesn't matter whether it's the Treasury or the Fed. The problem for the Fed is that normally it has a very small stock of treasuries. If the government is deficit spending, over the course of the year, it will be adding dollar for dollar reserves for every dollar of deficits. If you think back a couple years ago, the budget deficit was $1 trillion. A $1 trillion budget deficit will increase bank reserves by $1 trillion, dollar for dollar. In normal times, banks held about $50 billion in reserves. Adding $1 trillion means a massive amount of excess reserves. You have to drain them out. You do that by bond sales. Okay? So this is why the Fed has to coordinate with the Treasury and say, we need you to sell more bonds because we're running out. So the Treasury will sell bonds that drain the reserves out of the system because the central bank doesn't issue bonds. Okay? We could envision different ways of draining reserves. You could have your central bank issue bonds rather than the Treasury. The point is, it's not a borrowing operation, it's part of monetary policy. It's to allow the central bank to hit its interest rate target. Notice the logic here again is the spending comes first, then the bond sales. Spending goes first, then the tax receipts. The source of the currency is the government. The currency has to come first before you can collect the taxes or sell the bonds in order to drain the currency out of the system. Next point. Central banks are never really independent. They have to coordinate their operations with the Treasury. Okay, there are several reasons for this. One, I've just gone through. Every Monday morning, the Fed and Treasury talk. Okay? The Fed has a projection of what it thinks will be added to bank reserves. Okay? And this depends on how many people are going to cash their checks from the Treasury how many welfare recipients and social security recipients will cash their checks this week, because that will lead to reserve credits. And how many taxes will be paid this week? You can imagine the week before April 15, a lot of taxes are paid. Okay, that means a lot of reserves will be drained out of the system. You might have to put some in, which means the Fed will buy bonds instead of selling them. Anyway, they have to coordinate their operations, because the federal government is by far the largest economic entity in the United States. Its impact on bank reserves is by far the largest of any entity. And if they didn't coordinate their operations, the Fed would be stuck with either adding or draining reserves to offset the Treasury by massive amounts every day, hundreds of millions of dollars every single day, in order to make sure banks have the right amount of reserves. The Fed is the Treasury's bank. Modern treasuries don't spend by bringing wheelbarrows of cash up to buy the stuff that they're buying from contractors. They don't deliver wheelbarrows of cash to your home if you're a Social Security recipient. They use the banking system. Okay? So the Fed is the link between the Treasury and the entire banking system. The Fed makes and receives all payments for the Treasury. The Fed is the Treasury's bank. And for that reason, it can't be independent. This idea that somehow the Fed will prevent the Treasury from deficit spending by saying, no, sorry, no money in your account today, we're going to bounce your checks, is not going to happen. Never has happened, never will happen. If the central bank started bouncing Treasury checks because of insufficient funds, the president will call in the Fed and tell them, stop doing this. You're messing up the payment system, okay, the credibility of the U.S. government. It doesn't happen. So because they are responsible for making and receiving payments from the Treasury, they can't be independent. They have to accommodate the Treasury, and they always do. And the final reason I already went through has to do with the bond sales. So they got to coordinate the bond sales and possibly bond purchases with the Treasury. Treasury doesn't buy bonds, but it retires bonds, which has the same effect. It has to coordinate with the Treasury to make sure banks have the right amount of reserves. The only real independence the central banks have is that they can set the overnight interest rate target without political pressure. Okay? They can't be called into Congress and told what interest rate to set. I mean, they can be, but they are not. Congress has given them that independence. So they are free to set the overnight interest rate, and then the chairman of the Fed has to go to Congress sometimes and answer questions about it. Congress, if it wants to, could pass a law and say, from now on, the Fed funds rate will be 1% forever. And this is what the Fed must do. They can do that, but they're not likely to do that. So they've granted them that amount of independence, but that's all there is to it. Okay, and I think two more points. For every surplus, there has to be a deficit. If you think about an economy that just has me and you, if I spend more than my income, by accounting identity, you must have spent less than yours. Okay? If we look at the economy we're actually in, because income in the aggregate has to equal spending in the aggregate, it must be true again by identity that all of the surpluses of households, firms, and governments are equal to all the deficits run by other households, businesses, and governments. Okay? So it's very dividing the economy up into sectors. And we can divide them up any way we want. You know, we could have blonde-haired people and red-haired people, and black-haired people and brown-haired people. The deficits of one of those sectors got to be matched by surpluses of the other ones. Okay, that would be a silly division. So what we normally do is we say, let's take the private sector, households and firms taken together. Let's take the government sector, all levels of government taken together. And then let's take the rest of the world, okay, all other countries taken together. Okay, that's a convenient breaking up of our economy. Again, this must hold true. If one of those sectors runs a deficit, at least one of the others must have a surplus. The normal situation for the United States is the private sector taken as a whole runs a surplus, spends less than its income. And that makes sense. Why? Because households generally want to save for the future. They're saving for kids' college education, they're saving to buy a house, they're saving for retirement. So normally the private sector runs a surplus. The government sector, taken as a whole, almost always runs a deficit. Okay, you can go all the way back to 1789. The U.S. government has run a deficit in all periods except for 7 very short periods in which it ran surpluses. All other periods, it's run deficits. Okay. And the federal government deficits are big enough to more than offset the surpluses that are typically run by lower levels of government. Okay. So that's the normal situation for the United States and for most countries. Our rest of world sector runs a surplus against the United States since the days of Ronald Reagan. Okay. You hear about this as a trade deficit. And we run a trade deficit with the rest of the world. More technically, it's the current account deficit. Our current account deficit is offset by the rest of the world's current account surplus. They run a surplus against us. So take these 3 things together, it balances identically. Okay, I can show you a picture. It's a mirror image. The surpluses run by the private sector, as well as by the rest of the world, are matched by the deficits of the U.S. government, okay, since 1983. Before that, we actually ran current account surpluses, but they were pretty small, pretty much ignored. What this means is that it is impossible from accounting for the U.S. private sector to run a surplus and for the U.S. government to run a surplus. Can't happen. Okay? It could only happen if we ran current account surpluses, but we don't, and we're not likely to in the not even the near future, in the foreseeable future. We're not going to run current account surpluses. So if we want our private sector to save, which almost everyone thinks is a good idea, we must have our government running a deficit. Must. As I said, we've only had 7 periods where the U.S. government did not run deficits. The first 6 of those were followed by our only 6 depressions. The 7th was under President Clinton, followed by a severe recession, and then by the global financial collapse. So not a depression, but bad enough. Deficits are very bad for the U.S. private sector because we achieve them by having the private sector spend more than its income. For 10 years, the United States, before 2007, for 10 years, the U.S. private sector was spending more than its income, going deeply into debt. Okay. And in my view, this is why we had the collapse. The last time the U.S. private sector ran deficits was in 1929, followed by the Great Depression. Private sector deficits are really hard. They're very destabilizing. So, for every surplus, there has to be a deficit. You can think of it this way: the federal government deficit provides the private sector services in the United States and in most countries. Some countries run current account surpluses. They are able to run a balanced budget or even a government surplus without having their private sector deficit spending. But countries that either run balanced trade or current account deficits need their government to be running a deficit that provides the saving for the private sector to accumulate net financial assets. Those net financial assets take the form of currency and government bonds. Okay. So you know, in Times Square there used to be this debt clock. They moved it a little bit off Times Square. I'm not sure why. You've all seen it, right? You know what I'm talking about. The numbers are just flipping like this. It's showing the outstanding U.S. federal government debt. It's supposed to scare the heck out of you. Okay, because it's increasing every minute of every day, right? Except you could just as well say, here is national savings of our private sector, because the government deficit is creating the private sector savings. And so it's not debt, it's wealth. Government's creating our net financial wealth in the safest form there is, U.S. Treasuries. What the whole world wants. That's what our government's doing. Last, if you've got your own currency, you can't run out of it. You can always afford to spend more. This means you can always afford full employment. You can always afford to hire the unemployed, to create jobs for the unemployed. So one of the policy implications of modern money theory is full employment is completely affordable. You can't run out. The potential danger is it could be inflation. Okay, so we need to deal with that issue. But affordability, running out of money, as President Obama claims, we ran out of money. We would like to do more. Okay, during the global financial crisis, we had a stimulus package that lasted only 2 years. President Obama said, we would like to do more, but we just can't afford it. We've run out of money. The piggy bank is empty. This is false. Could have done a lot more. We could have, rather than having 25 million people unemployed, we could have put them to work. We could have afforded it. Okay, so now let me just quickly give the intellectual foundations of modern money theory. I'm not sure how much this will interest you know, dead economists, contributions that they had made that were forgotten. So the areas that modern money theory has adopted are work in the past in the areas of credit money, what's called the circuitous approach, endogenous money approach, functional finance, financial instability hypothesis, and the state theory of money. So just very briefly, I'll talk about each one of those and the main contributors that we drew on. So the first is George Frederick Knapp, who wrote a book, The State Theory of Money. So what he argued is that we need to look at the role of the state in choosing the money of account and issuing currency in that money of account. This was picked up by John Maynard Keynes. Before he wrote the general theory, he wrote a 2-volume work called The Treatise on Money, 1930. And in that book, he explicitly credited Knapp. But he also, long before that, Knapp wrote in German. It wasn't translated until 1924. But long before this, Keynes was the editor of the most important economics journal, even though he's a very young man at the time, the Economic Journal. He wrote a review of 2 articles published by, written by the Queen's ambassador to Washington, a guy named Mitchell Innes, who wrote a book on imprisonment called Martyrdom in Our Times, very opposed to using prison to punish, and beekeeping for the Queen. I guess it was her interest. His only other 2 publications. But he wrote 2 articles on money that were published in a banking law journal. They are the 2 best things ever written, in my opinion. Clearer than that. Keynes reviewed the first one, 1913, in the Economic Journal in 1913. He said, we might quibble with some of the arguments here, but the overall argument seems to me to be correct. And what Innes did was he started off his article saying, here's the story economists tell about money. And it's the very typical one that is still in every textbook, and if any of you took an economics course, you've heard this before. You have Robinson Crusoe and Friday, they're on an island, they're bartering fish for coconuts, it's very inconvenient, so they decide to use seashells as a medium of exchange. So that's supposed to be the story of the origins of money. And it says that this is all completely false. There's no evidence for this, and it's completely illogical. Okay? So instead, he presents a very different story of money that heavily influenced Keynes. In the late teens, 1919, Keynes had a period he called his Babylonian madness, investigating what they knew at that time about the development of money in Babylonia. Okay, and it is very similar to Knapp's story that it had to have come from the authorities. So Keynes spent this period studying the earliest money units, and he was sort of surprised to find that earliest money units, all of them that we know about, always were weight units, and they always were grain weight units. So the mina, the shekel, every early money, the pound, the lira, the term always was a weight unit. And so the hypothesis was that these came out of record keeping by the authorities. Okay. And so, anyway, Keynes picks this up and he says, I'm going to quote just very briefly. The state, therefore, comes in, first of all, as the authority of law which enforces the payment of the thing, so this is what I'm saying, the taxes, which corresponds to the name or description in the contracts. But it comes in doubly when, in addition, it claims the right to determine and declare what thing corresponds to the name and to vary its declaration from time to time, when that is to say, it claims the right to re-edit the dictionary. This right is claimed by all modern states and has been so claimed for some 4,000 years at least. So Keynes is pushing the origins of money back 4,000 years at least into the hands of the authorities. Not Robinson Crusoe and Friday. It did not come out of markets. It wasn't a replacement for inconvenient barter. Okay? It had to do with authorities who want to move resources to themselves. Okay? And our understanding of the origins of money is better today than it was in Keynes' time, because we had more work by historians and anthropologists. And if anything, Keynes was too conservative and only pushing it back 4,000 years. It looks like it goes back farther than that. It goes back to before writing. In fact, now, the historians of the development of writing think that writing was invented to keep track of money. Okay? All the earliest writing is about debts. And so we're never going to discover the origins of money because we're not going to find, the records. Oh, today I invented money. This is how I did it, so on. Because money already exists before, right? So there is speculation involved in it, but it certainly looks like it came out of the authorities. The best explanation that I know of comes from Grierson, who was the most famous expert on coinage. Coinage, by the way, is not old. Coinage only goes back to about 700 BC. So money existed long before coins. He argued that it probably came out of the tribal practice that in the case of Germany is called Wehrgeld. And that is the payment of fines. So in tribal society, if you injure somebody, you owe the family. And there's enforcement of the payment of the fine. So the hypothesis is that gradually over time, the authorities wanted to get some of that payment of the fine. And so now we say, you pay your debt to society. What does it mean? You pay the government. You don't pay the victims anymore, you pay the government. All of this is in Innis. It's part of this is critique of imprisonment. Anyway, but what does that mean? It means money didn't come out of the market. It came out of the penal system. It came out of fees and fines and then taxes. Taxes are punishment. For what? Original sin. You're born. You're guilty. Okay? So what do we always say? You can escape everything except death and taxes. There's a lot more you say. It's all bound up in religion. Almost all the terms, everything that has to do with money and debt comes out of religion. The first authorities almost certainly were religious authorities that enforced these payments to themselves. So anyway, going back to what is it? It's record keeping. What is that green piece of paper? It's a record. What are wooden tally sticks, which is the way most kings of Europe spent? They issued a tally stick. It's record keeping. It is the debt of the issuer. And this is what Innis made very clear. All money is debt. It's the debt of the issuer. Okay? What do they promise you when they issue debt? They promise that you can redeem yourself in payment of that debt back to them. The issuers of debt must take it back. Okay? That is the promise of every issuer of debt. They must take back their own debt in payment. So what is currency? Currency is the debt of the government. The government must take it back in payment to the government. What is a bank deposit? A bank deposit is the debt of your bank. They must take it back in payment of any debts you have to the bank. So you repay your loans with bank debt. So the same is true for all money. What is unique about the state's money is the state can put you into debt. Okay? You owe them taxes. Then they say, oh, here's my IOU. You can use this to pay your debt. Okay? So only the sovereign can put you involuntarily into debt. In all the other cases, you are more or less voluntarily getting into debt. You say, but I really needed that bank loan. Right? But there is at least some voluntariness in you choosing to become indebted to the bank. You don't have a choice whether to be indebted to the government. You owe taxes. So the state's money is the state's debt. Coins are the debt of the Treasury. Paper money is the debt of the Fed. And the government has agreed to accept it back in payment to the government. the world today, and we go back through time, Keynes said 4,000 years at least, but probably now we can push that back to 6,000 years ago. The typical case is, as Charles Goodhart, who worked at the Bank of England and at the Treasury at one point, put it, one nation, one currency rule. It's the Goodhart rule. And it's almost always true. When you go back in time, you will find that each nation had its own currency. When you go around the world, you find it's typically true. When the Soviet Union broke up into pieces, each piece chose its own currency, which is also typical. You will find historically exceptions to the rule, where countries adopt a foreign currency for domestic use. You will find today a huge exception, Euroland. So Euroland is a big deviation from what we see around the world and also back through history. But these are exceptions to the general rule that usually we have the state issuing its own currency from inception. In modern economies, the state doesn't directly spend the currency, as I was saying. The central bank stands there to make and receive payments for the Treasury. So it really will be reserves that are created, which are the liability of the Fed, rather than green paper notes, which is the liability of the Fed. The central bank stands ready to supply and drain reserves in order to keep its interest rate on target. And this idea was adopted in the endogenous money approach from the late 1970s. Post-Keynesians were arguing that central banks can't control the money supply. And what they mean by that is the money that is created by banks. They argue that when banks have good customers come in that look creditworthy, that want to take out loans, what the banks do is they credit their demand deposits, which is the bank liability. And that the idea that the central bank can constrain that by constraining reserves is just wrong. It doesn't understand the way that central banks actually have to operate. If they want to hit an overnight rate target, they have to supply the reserves that the banking system needs. If they want the payment system to function smoothly, they have to supply the reserves that banks need for clearing. So actually banks can't constrain, central banks can't constrain the quantity of reserves. They need to supply it on demand. In the 80s, when Post-Keynesians was writing this, this was very much against the mainstream, in which the mainstream argues central bankers can and do control the quantity of money. There's something called a deposit multiplier, so the banks can multiply the quantity of reserves, but the central bank can always control it. Over time, this view that central banks actually can't control the money supply has come to be accepted by virtually everyone who studies central banking and by central bankers themselves. So, for example, last year, the Bank of England put out a piece that says central banks cannot control the quantity of money. What we do is we set interest rates. But out of the various heterodox approaches that modern money theory was built on, this piece became widely accepted within the past years. Certain people, Bank of England put out a piece, like the banks actually can't control the money supply. It has come to be accepted by virtually everyone who studies central banking and by central bankers themselves. So, for example, last year, the Bank of England put out a piece that says central banks cannot control the quantity of money. What we do is we set interest rates. So out of the various heterodox approaches that modern money theory was built on, this piece became widely accepted within the past 20 years. The other pieces, not so widely accepted. The next early precursor is Ava Lerner, who developed what he called the functional finance approach. And he counterposed this to the sound finance approach. The sound finance approach basically sees the government budget as being similar to a household budget. And this is, widely accepted. You hear politicians all the time saying, if I ran my household the way that Uncle Sam runs his budget, I would go broke, which is true. Okay? Households cannot continually deficit spend. Okay? They will go bankrupt. Ava Lerner said, but this doesn't apply to a sovereign government that issues its own currency. It cannot go bankrupt. And in fact, it should not run its budget the way a household runs its budget, because its interest is the public interest. And balancing the budget, the government budget, has no obvious public purpose to it. Okay? The government can and should run its budget differently. Okay? And this is what he means by it should be a functional finance approach. Try to pursue the public interest. Well, what's the public interest? Ava Lerner said that the two most important things the government can do is to pursue full employment and relative price stability. And what that means is that you use the budget in order to achieve full employment. If there's unemployment, either taxes are too high or spending is too low. So you need to adjust those. You need to increase spending and reduce taxes in order to move the economy into full employment. Of course, if spending is too high and taxes are too low, you go beyond full employment, you get inflation. So the solution to that is to reduce spending and raise taxes. So this is functional finance. That is his fiscal policy recommendation. His monetary policy recommendation is that if the public has too much money, then the government ought to supply more bonds. If the public doesn't have enough money, the government ought to supply fewer bonds. You can see that this is very similar to what I was arguing before. The purpose of bond sales is to drain excess reserves out of the banking system. Okay? The purpose of bond purchases is to put reserves into the banking system. So this is exactly what Ava Lerner was recommending for monetary policy. In other words, you want to hit an interest rate target and you make sure that the banking system has the right amount of reserves. Beardsley Rummel, which is a great name, was the president, the name of the office in the 1940s was chairman of the Federal Reserve Bank of New York. He changed it to now presidents. The chairman of the Federal Reserve Bank of New York. And he's also the father of income tax withholding. Wrote two interesting papers at the end of World War II in 1946. One of them was titled Taxes for Revenue Are Obsolete. The purpose of taxes is not to raise revenue for the government. Okay? He says in the paper, World War II has taught us the government doesn't need tax revenue to spend. How did it teach us that? Because during World War II, the budget deficit was 25% of GDP. That's 5 times bigger than it is now as a percent of GDP. The government was 50% of GDP. The government debt ratio was 100% of GDP. He says, we learned in World War II, we don't need tax revenue to spend. Okay? serve other purposes. You can use taxes to fight inflation. You can use taxes to punish bad behavior. You can use taxes to change behavior. You can use taxes to reduce the income of the rich. But taxes are not for revenue. Okay? This is the chairman of the Federal Reserve Bank of Cuba. Hyman Minsky, who was my dissertation advisor, was famous for financial instability hypothesis. So this is also incorporated within modern money theory. The most famous line from Minsky is stability is destabilizing. So if the economy appears to be operating in a very stable manner, the problem is that people will change their behavior. They will assume that it's safe to take more risk. As they take more risk, the stability disappears, and you get financial crises. In one sense, that's the theory. And so, by using the understanding of sovereign currency, which came from Nab, Innis, Goodhart, and so on, we were able to, beginning in 1992, to write about the coming crisis in Europe. That the way that the euro was set up, by trying to divorce fiscal policy from the sovereign currency, as each country adopted a foreign currency called the euro, we said that this system will not be able to deal with its first serious financial crisis. And then following Minsky, we said, aha, we have our chairman, Greenspan, and Bernanke famous for eliminating risk. Okay? When Greenspan was the chair of the Fed, we said, oh, there's the Greenspan hook. In other words, you can go ahead and take all the risk you want because you know that no matter what happens, Greenspan won't allow anybody to fail. Bernanke even wrote a paper called The Great Moderation. Central bankers know what they're doing now, you can trust us, therefore there is no risk anymore. Financial crises are a thing of the past. We're not going to have them anymore. Okay? So we said, this is exactly what Minsky was talking about. The stability will create the instability. So we said, we're going to have a major financial crisis, compounded by the Clinton budget surpluses that put the private sector so heavily in debt, by the deregulation pushed by Greenspan, Larry Summers, Bob Rubin. We're going to have a massive financial crisis, which the U.S. will be able to deal with sovereign currency. Euroland will not be able to deal with it. They will face a crisis they cannot get out of. And so in addition to the creation of the blogosphere, being right about these two things also increased the credibility of the modern money theory. The last piece in the history of thought of the development of modern money theory is the idea of employer of last resort. So Abel says if there is any unemployment at all, it can be eliminated by the government spending more. Now, the problem is that you can get inflation. Lerner thought you get inflation only when you go beyond full employment. Now, in the 60s, he changed his mind on this. But writing in the 40s, his prescription was just spend more. Okay. The problem is we get inflation long before we get to full employment. And so the government has to cut back its spending, raise taxes, slow down the economy before we ever get to full employment. So Hyman Minsky, who's known for financial instability, in the 1960s worked to develop a proposal of employer of last resort. So he argued that only the government can afford to hire all the unemployed. And so it must be the government's responsibility in order to maintain full employment. And we do that with what we now call a job guarantee. We call it an employer of last resort. So what you want to do is design a New Deal's style jobs program in which the government takes workers as they are, pays them a wage which will become the minimum wage throughout the economy. Hopefully it's a living wage. And then finds useful things for people to do, just as the New Deal jobs program about this, 13 million people were employed in the New Deal jobs program. The biggest was the WPA, which employed 8 million people. You could still see the output of these workers all over the country. They build thousands of schools. They build probably tens of thousands of bridges, hundreds of thousands of miles of road. They built public buildings all over the United States. They brought a country that was a developing nation into the 20th century. It's not an exaggeration to say that they developed America. They made America a developed nation in the New Deal jobs program. So this is what Minsky had in mind when he talked about it. I won't go any more into the tiny details of how you run the program to make sure that it is not inflationary. But Minsky argued this pact will not cause inflation, whereas just having the government spend more could be inflationary. Okay, so anyway, those are the foundations. To just quickly conclude, the policy implications are, first, we need to stop saying we can't afford it. We can always afford it. There probably are a lot of spending proposals that are bad ideas. So we can always afford to spend, but we need to spend on things that make sense. We need to spend in a way that is not inflationary. We need to leave enough of the resources for the private pursuit of private interests. Americans like a small government, so I'm not necessarily arguing for a bigger government than we have now. We need to preserve a large private space, but it doesn't make sense to leave resources unemployed. If the private sector doesn't want to employ them, we ought to be employing them. And there are things that the private sector cannot do, such as public infrastructure, which is, much of that is not profitable. So this needs to be undertaken by the government. The second implication is, we need to stop talking about the central bank as if it were completely independent of government. It's not, and it should not be. It's a branch of government. It has some independence, but every department of government has some independence. We want them to be independent of, the day-to-day political games that can be played, and it's very good that we insulate our policymakers from that. But they are not independent of Congress. They were created by Congress. They're a creature of Congress, and Congress can change the laws if they don't like what the Fed is doing. We need to understand that balance is balance. It would seem like this is an obvious thing to state that at the aggregate level, the surpluses have to equal the deficits. But in 1999, there's the front page of the Wall Street Journal. I can show you by PowerPoint. On the left-hand column, there's a graph which shows the government sector running a surplus, and the headline is, "Isn't this great? For the first time since 1929, the U.S. government's adding to national savings by running a budget surplus." They show the picture. Then on the right-hand side, they show the private sector, okay? And of course, it's running a deficit. And the headline is, "Isn't it terrible? The private sector now is running a deficit, reducing national savings." There's no mention in either of the articles to the other article that it's an identity. You can't have the government sector running a surplus without the private sector running a deficit. So if we understood this, a lot of nonsense would disappear from public debates. If you like private sector saving and accumulation of wealth, then You love budget deficits, because it's the other side of the coin. It's the mirror image of the private sector safety. And so we would, I think if people understood this, we could change the nature of the debate about deficits and debt, whether government debt is a bad thing, whether it burdens the future generations and all that, because it's all based on not understanding that the balances have to balance, that the deficits accumulate to private sector accumulation of wealth, which most people think is a good thing. Yeah, I don't know what time it is. I have no watch. Well, it might be good to take questions.
So let's thank Randall Ray for attending. So why don't we do this? Anyone who needs to leave for a class or has anything, it can leave. And we'll go for 10 minutes, Randall, and ask.
Whatever you want.
Let's go till 5 till for anybody who wants to stay. So we got about 12, 13 minutes, and then we'll cut the video and we'll go there. What I thought we could do is we could just sort of like maybe have a few questions, and then we could decide how to field it.
Maybe I'll write it down.
All right. Does anyone? So I'm gonna alternate one, and then Gordon's got one. Does anyone else want to ask one? Rich definitely will. All the old professors. All of us.
Old professors?
I'm gonna just throw myself in there. Feel good about myself. So I just have here's my question, but we'll just go around. So, and this is speaking as someone who's, I wouldn't even say an office, really just running. Like for me, this talk was beautiful, like putting a lot of things together in a nice package for me. So first is, one is, well, so just thinking in terms of, you made a statement about a state cannot go insolvent. Well, I can imagine a situation where a state dissolves. So the state literally stops being a state. So that might be a way of talking about insolvency. And that could be due to political pressures that take the form of economic stuff. Like if Reeves had gone another, something like that. So so that's my first question to you. How would you engage that? And then the second question I have for you, slide 3. The second is, this seems like so logical. You put this to someone, it's very difficult to think how someone doesn't at least internalize a number of these points. So what is it in the social epistemology of economics or something that's stopping people from doing this, other than just sort of like humanist arguments of, it's blind, or it's just corruption, and then my third question for you is, you talked about the idea of taxes as punitive. For me, it just blew me away to think about the theological nature of that. And you talked about how there's a ranking of taxes and the worst type of taxes and like how that hierarchy. Would you be able to share just a little bit of that conversation, which is fascinating about thinking about how taxes would be levied? Thank you,
How much of the misunderstanding do you think comes from intentional misunderstanding? I am working for you for unfortunately run a lot of history, and I haven't seen much indication that people in power really give much concern to little folks. They tend to give most of their concern gaining more wealth and power. And given the fact that, beginning very early with the Pharaohs claiming to be God, kings, and owning the entire land of the nation, just wondering really how that plays into what you see going on in the current economic debate, because I'm quite suspicious that folks who are showing things that are so unequivocally true and obvious and refuse to acknowledge them, have got some other motive.
That's another issue. And I keep thinking about the third person. You're talking about the government surplus and the private sector. You also say this is international, the rest of the world. As you mentioned, China $3 trillion surplus. So I go back to World War II, but for the fact that every other economy in the world was destroyed in war, thereby allowing the United States to operate on a tremendous trade surplus, if there hadn't been a war, theoretically, all that debt that we acquired, couldn't you reach a point where a country that depends on imported goods to function no longer has a currency that another country will receive, and therefore is the equivalent of insolvency? Because they can't buy, no matter how much currency they issue, they can't buy the things necessary to continue to function. That third party is what concerns me. That's it.
Okay. All right. I guess I'll try to go in order. So currency sovereignty is only one dimension of sovereignty. So yeah, governments can lose legitimacy and dissolve and disappear. We need to have many other aspects of sovereignty, right? And currency sovereignty is just one of them. It's a very important one because it's the way that states move most of their resources to themselves. There are other ways to do it. The draft is one, and charity is another. We've used both in the United States. The draft wasn't too popular, and the charity doesn't work. I mean, every time you file your taxes, you have a chance to reduce the government's debt, you know. And I don't know how much the government gets from that. I think it's hilarious. And I think probably most people do too. They never check it, never contribute. Anyway, so yes, governments can disappear. And too much spending could be a reason. So too much spending will cause inflation. I don't think that actually explains the hyperinflation. So the story is always about Weimar and Zimbabwe, or that the problem was the government caused hyperinflation. I think this is completely false. And there are several good analyses of both of these situations that show that actually was not the cause of the hyperinflation. It will be true that the government will be printing a lot of money and spending a lot. Why? Because all the prices are rising really fast, and the deficits will be pretty big. But that's an effect of very high inflation, not the cause of the inflation in both of those cases. But government can spend too much. Government can spend on the wrong things, taking resources away from the private sector, bidding against the private sector, causing inflation. So that could be a big problem. It could be the reason why we lose legitimacy, maybe overthrown or invaded. And once you're overthrown or invaded, yeah, probably the currency is going to be valueless. Which, by the way, is part of the story of Goldstein. My view is that the reason why we went through this period when governments issued gold coins was because it was the era of conquest, so getting the gold, of fighting each other, of hiring mercenary armies who were not going to accept IOUs because you're fighting for a country, first, you really could care less about them, but second, they could well lose, in which case currency would have no value. So you demanded gold coins, which couldn't fall below the value of gold. So it all made sense. So anyway, yeah, if you're worried about the state surviving, you're not going to accept it. Well, there's lessons there. The study of the Confederacy is really interesting because you would think that as the outlook got more and more dire, the Confederacy would have had greater and greater trouble issuing currency and having people accept it and bonds too. Turned out not to be true. So patriotism may, offset it. Second, obvious. It seems and